Welcome back to The Young Investor, your trusted source for geoeconomic insights and their impact on young investors in Europe. Today, we're taking a comprehensive look at Germany's fiscal framework reform, a constitutional reform adopted in March 2025 that's set to reshape Germany's economic trajectory and, by extension, Europe's economic landscape. We'll explore the intricacies of this reform, its potential implications, and how it could affect young investors like you. To fully grasp the significance of Germany's fiscal framework reform, we need to understand the economic context in which it was adopted. Over the past decade, Germany's economy has seen periods of robust growth with downturns. However, recent years have been particularly challenging, with economic stagnation exacerbated by global trade tensions and increased tariffs. Germany's export-driven economy has been hit hard by these external factors, leading to slower GDP growth and rising unemployment rates. The current economic challenges have underscored the limitations of traditional fiscal policies and monetary measures. There's a growing consensus that more comprehensive and sustained approach is needed to revive the economy and ensure long-term growth. This is where the fiscal framework reform comes into play. By boosting GDP through public investment, the reform aims to create jobs, enhance infrastructure, and stimulate economic growth. The expectations are high, and the reform is seen as a critical step towards addressing Germany's economic woes. The reform is not just another economic stimulus package. It's a constitutional amendment. This means it has a long-term vision and a robust legal framework to ensure its implementation and longevity. The political process to pass such a reform was complex and required a broad consensus among Germany's political parties. This consensus underscores the urgency and importance of the reform in addressing Germany's economic challenges. At the heart of the reform is debt financing of an infrastructure fund. The government plans to issue bonds to raise the necessary funds, which will be allocated to various infrastructure and defense projects. The infrastructure fund will support a wide range of projects, including transportation networks, digital infrastructure, and energy systems. These projects are expected to have high multiplier effects, stimulating economic growth and creating jobs across multiple sectors. The focus on defense spending is also strategic. In addition to enhancing national security, increased defense spending is expected to stimulate the defense industry and related sectors. This could lead to technological advancements, increased exports, and further job creation. The potential benefits of this reform are extensive. Increased public investment in infrastructure and defense could lead to improved transportation networks, enhanced energy systems, and better public services. This, in turn, could boost business productivity, create jobs, and stimulate consumer spending. For young investors, this presents opportunities in sectors like construction, manufacturing, and technology, which are likely to benefit from the increased spending. Let's take a closer look at some of these sectors. In construction, the reform is expected to lead to a surge in construction projects, from roads and bridges to schools and hospitals. This will increase demand for construction materials, equipment, and labor, creating numerous investment opportunities. For manufacturing, improved infrastructure and increased demand for goods and services could stimulate growth in the manufacturing sector. Companies involved in manufacturing construction materials, machinery, and consumer goods could see significant benefits. In the technology sector, the reform's focus on digital infrastructure and defense technologies could drive innovation and growth in the tech sector. Companies involved in cybersecurity, software development, and hardware manufacturing could see increased demand for their products and services. In the renewable energy sector, infrastructure investment is also expected to support Germany's transition to renewable energy sources. This could create opportunities in the renewable energy sector, from wind and solar power to energy storage and grid management technologies. However, the reform also comes with its share of challenges and risks. One of the primary concerns is the reliance on debt financing. While this can stimulate growth in the short term, it also increases the country's debt burden, which could have long-term implications for economic stability. It's crucial for the government to manage this debt responsibly and ensure that the funds are used effectively to generate sustainable growth. Effective allocation and management of funds are also critical. There's always a risk of mismanagement or corruption, which could undermine the reform's objectives. To mitigate these risks, The government has put in place strict oversight mechanisms and transparency measures to ensure that funds are used for their intended purposes. Another challenge is the potential for economic shocks and geopolitical uncertainties. Global financial crises, trade wars, or geopolitical conflicts could impact the success of the reform. The government has emphasized the need for flexibility and resilience in its economic planning to mitigate these risks and ensure the reform's success. For young investors, the reform presents a unique opportunity to capitalize on emerging trends and position yourselves for long-term success. The increased public investment is likely to create a more dynamic economic environment with new opportunities for investment. Sectors like renewable energy, infrastructure, and technology are expected to see significant growth. This could translate into higher returns for investors who are well-positioned to capitalize on these trends. However, it's also crucial to be aware of the potential risks and to diversify your portfolio to mitigate any adverse effects from economic shifts. Here are some strategies to consider. Spread your investments across different sectors and asset classes to reduce risk. This could include stocks, bonds, real estate, and alternative investments. Focus on long-term growth rather than short-term gains. This approach can help you ride out market volatility and benefit from the compounding effect over time. Keep abreast of economic developments and policy changes. Understanding macroeconomic trends and their implications can help you make more informed investment decisions. To provide a well-rounded perspective, let's look at what experts in the market have to say about the reform. Economists and financial analysts have generally welcomed the reform, highlighting its potential to stimulate economic growth and create new investment opportunities. However, some experts have also cautioned about the risks associated with increased debt financing and the need for effective fund management. Market reactions have been positive overall. Following the announcement of the reform, there was a notable increase in investor confidence, particularly in sectors likely to benefit from the increased public investment. Stock prices in construction, technology, and renewable energy sectors saw significant gains, reflecting market optimism about the reform's potential impact. Germany's fiscal framework reform is a significant development that could reshape Europe's economic landscape. By boosting GDP through public investment, the reform aims to stimulate economic growth and create new opportunities for investors. However, it's essential to approach this with a balanced perspective, understanding both the potential benefits and the associated risks. For young investors, this reform presents a unique opportunity to capitalize on emerging trends and position yourselves for long-term success. Thank you for tuning in to The Young Investor. If you found this episode helpful, please share with your friends and leave us a review. Until next time, stay informed and keep investing wisely.